Here's the truth about dividend investing that nobody talks about. Most people are doing it completely backwards. They're 25 years old buying high dividend yield stocks for retirement that's 40 years away. Or they're 65 buying growth stocks when they need income today. It's like bringing a snow shovel to the beach. Right tool, wrong time. Today I'm showing you the Dividend Growth Pyramid, updated with 2025 data, that could potentially solve this problem forever. This simple framework shows you exactly what to buy and when based on your investment time horizon. And stick around because I'm revealing the exact compound math that could potentially turn a 0.86% yield into 14.5% by retirement. This content is for educational purposes only. All investments carry risk of loss. Past performance doesn't guarantee future results. Dividend payments can be reduced or eliminated. Consult a financial advisor before investing. Look at these two scenarios. Scenario 1. You're 30 years old. You buy Realty Income yielding 5.76% today. Feels good, right? But over 30 years, those dividends have historically grown at 4% annually. By retirement, inflation could potentially have eaten your lunch. Scenario 2. You're 30 years old. You buy Broadcom yielding 0.86% today. Looks terrible. But those dividends have historically grown at 12% annually. By retirement, you could potentially be getting 30% yield on your original investment. Same starting point. Potentially completely different outcomes. The difference? Compound dividend growth versus chasing current yield. But there's one company in this pyramid that's actually done both, and I'll reveal which one later. This isn't just about picking stocks. This is about potentially achieving financial independence. Get this right, and in 20 years you could potentially be earning dividend income that replaces your entire salary. Get it wrong, and you'll be working until you're 75 because your income never kept up with inflation. The Dividend Growth Pyramid could potentially fix this by matching your investment strategy to exactly where you are in life. No more guessing, no more confusion. Just a clear roadmap to potentially live off dividends. How the pyramid works. Think of the pyramid like a simple ladder. Visual, pyramid structure. At the bottom, you have high yield, low growth. Perfect when you need income today. At the top, you have low yield, high growth. Perfect when you need income in 20+ years. Everyone starts with the same foundation, SCHD and DGRO. These are your core ETFs that could potentially work for every age and every timeline. Then you add layers based on one simple question. How many years until you need this money to replace your salary? 1 to 3 years? Focus on the bottom. 3 to 5 years? Lower middle, 5 to 10 years? Middle, 10 to 20 years? Upper middle, 20+ years? Top of the pyramid. It's that simple. But here's where it gets interesting. One of these ETFs has historically delivered 54.98% returns over 5 years, while most investors completely ignore it. Foundation layer. Everyone starts here. No matter if you're 25 or 65, you need this foundation. SCHD, the backbone. This ETF only buys companies that have paid dividends for 10+ straight years. Currently yielding 3.96% with an expense ratio of just 0.06%. Over the past 5 years, it's historically delivered 42.25% total return. Think of SCHD as your safety net. Companies like Verizon, Coca-Cola, and Cisco. Boring? Yes. Historically reliable? Absolutely. DGRO, the growth engine. This ETF focuses on companies actively growing their dividends. Currently yielding 2.22% with that historical 54.98% 5-year return. Top holdings include Microsoft, Broadcom, and JP. These aren't just dividend-paying stocks. They're companies with the financial strength to potentially increase those payments year after year. These two ETFs should make up 40 to 60% of your dividend portfolio regardless of your age. But wait until you see what happens when we start adding the individual layers. Bottom tier. 1 to 3 years to retirement. If you need income now or very soon, this is your focus. JEPI, the income powerhouse. Yielding 8.38%, this fund sells covered calls on big companies to potentially generate monthly income. You own stocks like Visa, Microsoft, and Meta, but cap your upside to get paid monthly. Perfect for retirees who want high current income. JEPQ, even higher at 11.62% yield using the same strategy on NASDAQ stocks. This fund owns Nvidia, Microsoft, And Apple. More income, but you're giving up growth in the world's best tech companies for immediate cash flow. But here's the crazy part about JEPQ. It's basically paying you to own the companies that are driving AI and the future economy. You're getting paid 11.62% to hold NVIDIA. Think about that for a second. VNQ, Real Estate Income, yielding 4.06%. This REITE ETF owns companies like American Tower and Prologis. REITEs are required by law to distribute 90% of their income, making them natural income generators. BND, the Bond Foundation, yielding 3.78% with a 0.03% expense ratio. Realty Income, the monthly dividend company, yields 5.76% and has historically paid monthly dividends for 658 consecutive months. With 30 consecutive years of dividend increases, they own retail properties and collect rent, passing it to you as dividends. Southern Company, SO, the utility giant yielding 3.35% with 25 consecutive years of dividend growth. People always need electricity, they always pay their bills. You always get your dividend. Lower mid-tier, 3 to 5 years out. Risk note: individual stocks carry company-specific risks and sector volatility. You want income soon, but you have time for modest growth. HDV. This ETF screens for financially healthy companies with high dividends, currently yielding 3.52%. Top holdings include ExxonMobil and Johnson & Johnson. Think quality high-yield companies, not dividend traps. DHS, the concentrated high-yield play, yielding 3.52%. This fund targets the highest-yielding segment of the market. Coca-Cola, KO, the classic, yielding 2.87% with historical 53 consecutive years of dividend increases. With a wide economic moat and exemplary capital allocation, people drink Coke in good times and bad times. Lockheed Martin, LMT, defense contractor, yielding 2.75% with 22 consecutive years of dividend growth. Government contracts that last decades mean predictable revenue. The F-35 program alone provides visibility for years. Public storage, PSA, the self-storage king, yielding 4.04% with historical 8.45% dividend growth over 31 consecutive years. People always need to store stuff. Economic downturns actually increase demand as people downsize homes. Now here's what most people miss about this tier. These companies have historically become more valuable during recessions. Coca-Cola and Lockheed Martin have been historically recession-proof, but there's one company coming up that's even better. Middle tier, 5 to 10 years out. The sweet spot, good yield today, potentially solid growth ahead. VYM, Vanguard's high dividend ETF yielding 2.84%. Broad exposure to dividend-paying stocks across all sectors with ultra-low 0.06% expense ratio. Over 5 years, it has historically delivered 52.01% returns. Top holdings include Broadcom, JP Morgan, and ExxonMobil. This gives you exposure to financial services, technology, and energy. VYMI, international version yielding 4.11%. Companies like Nestle, Toyota, and HSBC. International dividend yields traditionally run higher than U.S. markets. PepsiCo, PEP, yielding 4.32% with historical 7.54% dividend growth over 53 years of increases. This dividend king combines beverages and snacks in one recession-proof business. PepsiCo owns Lay's, Quaker, Doritos, and dozens of other brands. McDonald's, MCD, yielding 2.27% with historical 48 years of increases. With a wide economic moat built on brand recognition and prime locations, they own the land and collect rent from franchisees. Waste Management, WM, yielding 1.37% but historically growing at 8.11% annually over 22 consecutive years. With a wide economic moat from regulatory permits, everyone creates trash and someone has to pick it up. Here's what's beautiful about waste management. It's literally impossible to disrupt. You can't app your way out of garbage collection, and they have pricing power that would make Apple jealous. Upper mid-tier, 10 to 20 years out. Lower yield now, but potentially accelerating growth. Microsoft, MSFT, yielding just 0.858%, but historically growing dividends at 11.45% annually over 20 consecutive years. With a wide economic moat and exemplary capital allocation, Azure Cloud Business is printing money. Only paying out 24.9% of earnings as dividends means massive room to grow. Home Depot, HD, yielding 2.47% with historical consistent growth over 16 years. With a wide economic moat and exemplary capital allocation, housing always needs maintenance and improvement. Home Depot dominates this market with incredible supply chain efficiency. These companies give you some dividend income today while potentially building serious wealth for tomorrow. Perfect for your 30s and 40s when you're building toward financial independence. But Microsoft is the company I mentioned earlier that proves tech companies can potentially be reliable dividend payers. They've gone from startup to dividend aristocrat status while dominating cloud computing. Top tier, 20+ years out. This is where young investors could potentially build wealth. Broadcom, AVGO, yielding 0.86%, but historically growing dividends at 12.07% annually over 13 consecutive years. This semiconductor giant buys companies, optimizes them, and grows cash flow. With a wide economic moat and exemplary capital allocation, they've mastered accretive acquisitions while maintaining dividend growth. Texas Instruments, TXN, yielding 2.82% with historical 9.76% dividend growth over 21 consecutive years. As the world's largest analog chip maker with a wide economic moat, these chips go in everything from cars to phones to factories. Lowe's, LOW, home improvement competitor to Home Depot. Similar business model, similar opportunity, similar wide economic moat. Housing market growth drives both companies' dividend growth. Look, these yields look terrible if you need money today. But if you're 25 and want to retire at 55, this could potentially be your wealth-building engine. And Broadcom is the perfect example of why you might want growth over yield when you're young. Here's how you actually build this thing. Step 1. Start with your foundation. Buy SCHD and DGRO. These could potentially work for everyone, every age, every timeline. Step 2. Figure out your timeline. When do you want these dividends to potentially replace your salary? Be honest. Step 3. Weight your pyramid accordingly. 25 years old? 80% foundation and top tiers. Focus on AVGO, TXN, low, MSFT, HD. 35 years old? 60% foundation and upper tiers. Add VYM, VYMI, PEP, MCD, WM. 45 years old? 50% foundation, heavy middle tier. Balanced approach. 55 years old? 40% foundation, focus on lower tiers. Weight toward HDV, DHS, KO, LMT, PSA. 65 years old? 30% foundation, heavy bottom tier. Focus on JEPI, JEPQ, VNQ, OSO. But here's the secret most financial advisors won't tell you. You can shift between tiers as your timeline changes. The pyramid isn't static. The compound magic. Here's why this could potentially work. And this is the math I promised you at the beginning. Let's say you invest $10,000 in Broadcom today at 0.86% yield. You get $86 in dividends year one. Pathetic, right? But if they keep growing dividends at 12% annually, which they've done for 13 straight years, watch what could potentially happen. Year 5, $152 in dividends. Year 10, $267 in dividends. Year 15, $470 in dividends. Year 20, $826 in dividends. Year 25, $1,453 in dividends. That's a 14.5% yield on your original investment, without buying a single additional share. This is compound dividend growth. This is how you could potentially live off dividends. This is the magic that could potentially turn small yields into retirement income. The dividend growth pyramid isn't complicated, it's logical. Match your investment strategy to your time horizon. Buy growth when you have time. Buy income when you need it. Start with SCHD and DGRO as your foundation. Then, layer in the companies and ETFs that match your timeline. Don't chase the highest yield. Don't ignore yield completely. Use the pyramid to find the potentially perfect balance for where you are in life. This is how you could potentially build passive income that actually grows. This is how you might achieve financial independence through dividend investing. Success requires consistent execution and favorable market conditions over long periods. Build the foundation. Follow the pyramid. Watch your wealth potentially compound year after year. That's how you could potentially replace your salary and live off dividends. Remember that all investment strategies carry risk and results are not guaranteed.